Today's presentation is about LKAS 1. Now we have entered a new chapter, that is chapter 2. We are going to, from today after, from today onwards, we are going to start, we start learning LKAS. All the theory parts we have done in the previous sessions. Now we start LKAS 1. Presentation of financial statement, especially this LKAS 1 deal with general purpose, general features of general purpose financial statement. Right. I hope all of you are familiar with LKAS, Sri Lanka Accounting Standards. Now we will discuss the first standard, that is presentation of financial statement, general features of general purpose financial statement. I hope I have already given you all the explanation about the terminologies, accounting terminologies and accounting concepts. So I hope I don't want to explain again and again about that concepts. Right. So learning objective, learning outcomes. At end of the session, the students would be able to comprehensively understand the purpose, objectives and frameworks of general purpose financial statement. You know, we have in accounting, according to the LKAS, we have 5 elements, 5 statements, 5 components, statements, income statement, balance sheet, cash flow statement, changes in equity, and notes. But it gives a particular definition of such statements. In it has an official names, like for income statement it has a statement of financial performance. For balance sheet it uses a statement of financial position. The cash flow statement, statement of fund flow, and statement of changes in equity, and explanatory notes. So these are the 5 things. And this framework, this standard will explain first part, the objective of the standard of the framework, and second objective is describe the general features of financial statement and its implication and importance on presentation of financial statements. And 3, understand the structure and content of financial statement with various guidelines and minimum requirement to be met while its preparation and presentation. So these things are not new for you. You know what is income statement, what are the things you can find there, and what is the structure. So all of stuffs, you know. Now we are going to just recall it. So first we'll look at the objective of LKAS 1, that is presentation of financial statement. So LKAS 1 prescribe the basis for the presentation of general purpose financial statement to ensure comparability. You know what do you mean by comparability? Compare the statements, compare the financial statement with earlier period or with other organization, other entity. Both with entities financial statement of previous periods and with the financial statement of other entities, right? So the purpose is to, the purpose of LKAS 1 is to prescribe, it's give an idea about how to present financial information via financial statements. So that's a major objective of the LKAS 1. And it set out overall requirements. It set out overall requirements for the presentation of financial statement, guidelines for their structure, and minimum requirement for their content. Scope, so limitation. So this LKAS 1 deal with what? LKAS 1, it deals with what? So an entity shall apply this standard LKAS 1 in preparing and presenting general purpose financial statements. Preparing general purpose financial statement in accordance with Sri Lanka Accounting Standards. So it's clearly limits its scope. An entity shall apply this standard in preparing and presenting general purpose financial statement in accordance with Sri Lanka Accounting Standards. Sri Lanka Accounting Standard. Sri Lanka Financial Reporting Standard should be, right? Sri Lanka Financial Reporting Standard. So this standard does not apply. This standard will not cover the structure and content of condensed interim financial statements prepared in accordance with LKAS 34. So LKAS 34 is about interim financial reporting. So normally financial statements are prepared for 12 months. In some cases, some entities will prepare financial statement on monthly basis, quarterly basis, or semi-annual basis. But this standard will cover usual financial statement, that is for 12 months. So interim financial statement is explained by the interim financial reporting is dealt in LKAS 34. However, paragraph 15 to 35 apply to such financial statements. This standard applies equally to all entities, including those that present consolidated financial statement in case of acquisition, merge and acquisition, consolidated financial statement, so holding company, subsidiary, that sort of stuff. So this standard, this standard applies equally to all entities, including those that present consolidated financial statement in accordance with SLFRS 10, Sri Lanka Financial Reporting Standard number 10, consolidated financial statement, and those that present separate financial statement in accordance with LKAS 27, separate financial statement. So it does not deal with this kind of stuff. So it's focused on usual financial statements. Now we'll discuss about the purpose of financial statement. Purpose of financial statements. Financial statements are a structured representation. Financial statements are the structured representation of financial position and financial performance of an entity. So when you look at an income statement, so there's a particular format. We can find some item at the top of the statement. We can find at the bottom of the statement. You can find some elements in the middle of the statement. So when you look at any income statement for any other companies, in similar nature, you can find those elements because it's a unique structure. It clearly explains what are the elements should be included in the income statement, in the balance sheet, in the cash flow statement, right? So it's explained. Financial statements are a structured representation of financial position, how much the assets and liabilities available and equities available, and financial performance, how a firm performs, whether the company earns profit or making loss. So that sort of information will be channeled, that sort of information will be conveyed through the financial statements. So that is the objective. The objective of financial statement is to provide financial information. The objective of financial statement is to provide information about the financial position, balance sheet, financial performance, profit or loss, and cash flow of an entity, how cash move to or move from the organization or the entity. That is useful to a wide range of users in making economic decisions. So Especially the financial statements are prepared by targeting investors, widely investors, mainly. Majority of the users are the shareholders. So those, so we call them as a so then those people are not uh, very much knowledge in accounting, but they're able to understand the informations. So the objective of the financial statement is to provide information about the financial position, financial performance, and cash flows of the entity that is useful to a wide range of users in making economic decisions. Financial statements also show the result of the management stewardship of the resources entrusted to it. Financial statements are also show the result of management stewardship. So we have already discussed what do you mean by stewardship. In simple terms, we can say on what degree the level of management behavior towards the objective of shareholders. It is opposite to the agency problem, agency theory. So financial statement also show the result of the management stewardship of the resources entrusted to it. So we have discussed a lot about the stewardship. So when a reader looks the financial statement, from that statement they can understand whether stewardship, the management whether having a stewardship behavior or contradictive behavior with shareholders. And the purpose of financial statement to meet this objective, it means provide financial information. To meet this objective, financial statements provide information about an entity's assets, liabilities, and equities. Those three elements we can find in balance sheet, financial position. Income and expenses, including gain and losses, you can find in income statement. Contribution by and distribution to owners in their capacity as owners, you can find from statement of changes in equity. And cash flows, how cash balance are moved from one place to another place, how money is come into the organization or go out from the organization. So all such informations can be channeled through the financial statement. So this information along with other information in the notes, we can find notes at end of their uh, financial statement, explanatory notes, not right. So this information along with other information in the notes help user of financial statement in predicting the entity's future cash flows and in particular their timing and certainty. So not all the information can be provided in the financial statement. In addition to that, there will be published issues and notes where you can find, the reader can find additional information. So based on that information, shareholders can make relevant economic decisions. Complete set of financial statements. A statement of financial position, balance sheet, as at end of the period, financial position at end of the period, and statement of profit loss and other comprehensive income for the period. So when you get the balance sheet, you can find the title is like this: balance financial position of XYZ company as at, you can find the word as at 31st March or whatever, or 31st December, like that. Date, on the date, assets, liabilities, securities on a particular date. But when you look at the income statement, the heading, the title of the income statement clearly explains the income statement for the period, not asset, for the period ended on a particular date. So the statement on profit or loss and other comprehensive income for the period. Each one, the income statement, the financial position at end of the period, asset. A third, a statement of changes in equity for the period, how equity balances has moved. A statement of cash flows for the period. Notes comprising a summary of significant accounting policies and other explanatory information. Right? Notes comprising a summary of significant accounting policies and other explanatory information. Comparative information in respect of the preceding period. So also we can find information about the previous period. When you look at annual report, where you can find financial statement, when they disclose the financial statement and information, they will publish along with the previous year data for the easiest comparativeness. A statement of financial position as at the beginning of the preceding period. An entity applies an accounting policy, right? An entity applies an accounting policy retrospectively or makes retrospective restatement of the item in its financial statements when it classifies the items in the financial statements. Reports and statement outside scope of SLFRS. Right, now we look at outside scope of the SLFRS. Reports and statement outside scope of the SLFRS, Sri Lanka Financial Reporting Standard, but we are discussing about LKAS, Lanka Accounting Standard. These two different things. Reports and statements presented outside the financial statement are outside the scope of SLFRS. When you look at the annual report, in addition to financial statement, we can find there are some reports, management review, right? Management review, corporate governance review, and risk management. So you can find additional information. Financial review by management. So that describes and explains the main features of the entity's financial performance and financial position, and the principal uncertainties it faces. Such a report may include a review of the main factors and influences determining the financial performance. So what are the things, what are the variables, so what are the environmental factors impacts on its profitability, financial performance, organization and its performance, including changes in environment in which entity operates. The COVID-19 pandemic is one of the environmental factor. It affects organization in favorably for some organization, for most of the organization adversely affected. And in this report you can find how COVID-19 pandemic impacts on performance of the company. So that sort of information you cannot find in the financial statement, but you can find such information from the management review, financial review by the management. The entity's response to those changes and the effect, and the entity's policy for investment to maintain and enhance financial performance, including its dividend policy. The entity's source of funding and its targeted ratio of liabilities to equity. And also they will give us information about financial leverage. There you can find some ratios, some ratio analysis, interpretations in the annual report. So it normally includes in the under the review. And the entity's resources not recognized in the statement of financial position in accordance with SLFRS. So some resources cannot be recognized in the financial statement because of the measurement and recognition concept. So when it fails in recognition criteria, it may not disclose in the financial statement, but this kind of information, if that is material, it can be found in their review by the management. And you can find a report and statement such as environmental report, value added statement, etc. So when you take the annual report, you can find there are so many things in addition to financial statement they have provided. Now let us discuss about the general features. General features of financial statement. First, fair presentation and compliance with Sri Lanka Financial Reporting Standard. Fair, not bias, not manipulated. It's a fair presentation, and it should compliance with Sri Lanka Financial Reporting Standard, not with Indian Accounting Standard or American Accounting Standard. So not. So our LKAS is compliance with SLFRS. Going concern. So going concern, it means what? When company prepare financial statements, they assume that the company will operate the near future for foreseeable future. For the foreseeable future. Accrual basis accounting. So you know what do you mean by accrual basis and case basis. So LKS 1 emphasize on accrual basis accounting. Materiality and aggregation. Materiality, you know, some amounts are not wanted to disclose. And aggregation, some items make it together. So when you look at the property, plant, equipment, so you can find machinery. So they put machinery in a single line, but in the machinery there are so many types of machineries. So it's aggregation, totally the same class of assets, same class of income, same class of expenditures are make it together. Offsetting, sometimes when show some balance, net figures, they're putting net figures, debit, credit. So some, for example, when they show the income, other income, they don't want to show how much income received, how much expenditures occurred to earn that income. So directly they can put on the net, so they can offset the expenses offset the revenue from a particular source of income. Frequency of reporting, every 12 months it presents one report, one financial statement every 12 months. Frequency of the reporting is 12 months. Comparative information, compare, it can be compared with other organization financial statements as well as the same company's previous year financial statement. Consistency of presentation, consistency, you know, they should follow the same policy throughout the accounting period. So general features. First we look at a fair presentation and compliance with SLFRS. Fair presentation, you know what do you mean by fair presentation? We have discussed a lot in the previous sessions, so I will go a little bit faster. A financial statement shall present fairly the financial position, financial performance, and cash flows of an entity. So fair presentation requires the faithful representation without any bias, right? That is the main. Without bias, it should present actual figures. Fair presentation requires the faithful representation of the effect of the transactions, other events and conditions in accordance with the definitions and recognition criteria for assets, liabilities, income, and expenses set out in the framework. The application of Sri Lanka Financial Reporting Standards with additional disclosure when necessary is presumed to result in financial statement that achieve a fair presentation. Going concern, very familiar. concept, going concern. The company does not have any idea to stop their business in the near future. The business will continue for foreseeable future without any bankruptcy or insolvency issues. So when preparing financial statements, management shall make an assessment of an entity's ability to continue as going concern. An entity shall prepare financial statement on a going concern basis unless the management either intend to liquidate the entity, right? They are going to stop the operation, or to cease trading, they are going to stop trading, or has no realistic alternative but to do so. And also the entity do not have any feasibilities to continue their businesses. When management is aware in making its assessment of material uncertainties related to events or conditions that may cause significant doubt about the entity's ability to continue as going concern. So the entity shall disclose those uncertainties. So sometimes there are some situation arises. During that time, the management should pay special attention about their continuity of the business. That's mean going concern. If the management identified any signals of such, they should disclose in their financial statements. They should disclose in the financial statement. They have to report about, so the company is facing very difficult or risky situations, uncertainties, if it is material only. So when an entity does not prepare financial statements on a going concern basis, it shall disclose that fact together with the basis on which it prepared the financial statement and the reason why the entity is not regarded as going concern. The entity may reach a conclusion that the going concern basis of accounting is appropriate without a detailed analysis when an entity has. So historical profitable operations and ready access to financial resources, right? So they are not, so if they have any serious signals on going concern issue, that time only they have to disclose. So the thing, but any other times, any other conditions, they have to give evidence that the company does not have any issues in going concern. They have to keep in their files evidence. The entity may reach a conclusion that going concern basis of accounting is appropriate without detailed analysis. Don't want detailed analysis because they have good profitable operations in the recent year and they have able to access financial resources, money. If they want, they can get money, resources, financial resources. In other cases, before it can satisfy itself that the going concern basis is appropriate, management may need to consider a wide range of factors. So current and expected profitability, debt repayment schedules, and potential source of replacement of financing. So if they satisfy on this, so they can assume going concern assumption. Now we'll move to the accrual basis of accounting. So it's opposite to cash basis, right? Accrual basis of accounting. An entity shall prepare its financial statements except for cash flow information using the accrual basis accounting. So the balance sheet, the income statement, statement of change in equity, all these should be prepared according to it on accrual basis, not cash flow statement. When the accrual basis of accounting is used, an entity recognizes items as assets, liabilities, equity, income, and expenses. the element of financial statements, right? These are the elements of financial statements. When they satisfy the definition and recognition criteria for these, for those elements, we discuss about what's the criteria for the definition and recognition criteria, right? They have to consider this thing. Materiality and aggregation. Importance, materiality. Whether is it important to disclose the information or not. That is materiality. Aggregation, make it total. So there are so many times sales occurred, but we couldn't find a sales date wise or incident wise, but we can find the sales on one sentence, sales, total figure. It's aggregation. And all the administrative expenses are titled at admin expenses. All the sales and distribution expenses are put together under the heading of that sales and distribution expenses, finance cost, like that. So an entity shall present separately each material class of similar items. An entity shall present separately each material class of similar items. An entity shall present separately items of dissimilar nature or function unless they are immaterial. Financial statement result from processing large number of transactions or other events that are aggregated into classes according to their nature of the functions, right? Throughout the 12 months, so there are so many transactions, but we couldn't find those transactions in the financial statement. Rather, we can find the total figure, the final figure, because of aggregation, because of their aggregation, total, grouped, categorized. The final stage in the process of aggregation and classification is the presentation of condensed and classified data, which form the line items in the financial statement. In a line item is not individually material, it is aggregated with other items either in those of statement or in the notes. An item that is not sufficiently material, so not important, to warrant separate presentation in those statement may warrant separate presentation in the notes. So if it is not qualified, uh, it is not qualified to disclose such uh, transactions in the financial statement, but anyhow, if it is material and it can be disclosed in the financial notes, explanatory notes. In terms of value, money is not material, but in some other facts, it should be disclosed. An entity need to provide a specific disclosure required by a standard if the information is not material, right? An entity need not provide special disclosure requirement by a standard if the information is not material. So if the information is not material, no need to disclose even in the notes. An entity shall not offset assets and liabilities or income and expenses unless required or permitted by a standard, right? Offset, cancel out, right? So for example, 100 rupees income, turn that 100 rupees income, we spend 20 rupees. So when disclosed that income, we put simply 80 rupees. No need to separate, because that income, that that expenditure is set off with the offset with the income. So therefore, final figure is okay, is acceptable. So offsetting. An entity shall not offset assets and liabilities or income and expenses unless required or permitted by the standard. In accounting, offsetting, netting in the presentation of net amounts of assets, liabilities in the statement of financial position as a result of an entity's rights of set-offs. So offsetting is important because when applied, it reduces the amount of assets and liabilities presented in the statement of financial position. So when we look at the all, most of the items are not offset. It is disclosed as it is. So here normal operations are not set off. So other income, then so that kind of items disclosed in the financial statement in net figure, right? In net figure. An entity reports separately both assets and liabilities and income and expenses. It should be separate. So if the assets are set off with liabilities, we get finally what? Net assets, that is equal to equity. So the financial position, the balance sheet is not like that. It shows the things separately. The assets and liabilities are not offset at each other, right? The offsetting in the statement of comprehensive income or financial position or in the separate income statement, if presented, except when offsetting reflects the substance of the transaction or other event. Detract from the ability of users both to understand the transaction, other events, and conditions that have occurred, and to assess the entity's future cash flows. When the entity decides to set off offsetting the balances, that offsetting is not mislead, is not mislead to take a different decisions, not misguided. It should not harm the understanding of the financial information by the users. So if such situation is okay, they can net it. So measuring assets net of valuation allowances, for example, obsolescence allowances on inventories and doubtful debt allowances on receivable is not offsetting. No, when you find the receivable, you can find receivable amount minus provision for doubtful debt, provision for bad debt. So that kind of information is given in detail, not net off, right? Frequency of reporting. Right, every 12 months, an entity disclose their financial information, prepare financial statement. An entity shall present a complete set of financial statement, including comparative information, at least annually, simply 12 months. When an entity changes the end of its reporting period and present financial statement for a period longer or shorter than 1 year, an entity shall disclose in addition to the period covered by the financial statement. So sometimes companies wanted to prepare a financial statement less than 12 months, not interim financial report. So less than 12 months, for 9 months or 10 months or 12 months, sorry, not 12 months, 11 months, 3 months, 2 months sometimes, due to some unavoidable reasons. Sometimes the company may dissolve other adverse things. So the reason for using a long or shorter period. So sometimes the company prepare financial statement for 14 years, 15 years, more than 12 months, right? 14 months, 12 months, not 12 months, 14 months, 13 months, 15 months, right? So exceeding 12 months. In such instances, they have to clearly explain what the reason for the the reason for the using longer or shorter period for the reporting of financial information, and the fact that amounts presented in the financial statements are not entirely comparable, right? So in the previous period they have prepared financial statement for 12 months, but now they have prepared financial statement for shorter period or longer period. So that time the comparability issue will arises, compare between previous year and this year, and also comparability with this organization with another organization is not appropriate. So therefore they should disclose, they should explain the fact, they have to present the fact about uh, the fact that amount presented in the financial statements are not entirely comparable. Normally, an entity consistently prepares financial statement for a 1 year period. For 1 year period. However, for a practical reason, some entities prefer to report, for example, 52 weeks period. Normally, we follow 12 calendar month. Start from 1st of January, or start from 1st of April and end on 31st December or 31st March. So it is 365 days or 364 days. But some organizations, they have a policy to prepare financial statement for 52 weeks. 52 weeks. So this standard does not preclude this practice. So this standard is not oppose that kind of practices. General features, comparative information. Comparative information. Compared information, it can become in here we have two things: minimum comparative information. Minimum comparative information to compare the financial statement with previous year or another entity. It should meet a threshold, minimum requirement, minimum comparative information. It should have such a minimum requirement. And additional, in addition to the basic, in addition to the minimum comparative information, they can give additional information, additional comparative information. Now we'll discuss about minimum comparative information. So minimum comparative information in respect of the preceding period for all amounts reported in the current period's financial statements, right? So comparative information in respect of the preceding period, previous period, for all amounts reported in the current period's financial statement. When you look at the annual report of any company, you can find both. So I can show it. When you look at the annual report, so you can find both. Right here. So this is 2020 year's financial statement, right? But when they present financial statement, they include previous year figure also, last year figure also, because for the purpose of comparativeness. This is minimum. So that's why you can find all the financial statements. All the financial statement, you can find two columns. The first column, one column is dedicated for current year, and another column is dedicated for the previous period for the purpose of comparability. And comparative information for narrative and descriptive information, narrative in an order, as like a story. Comparative information for narrative and descriptive information if it is relevant to understanding current periods financial statement, current periods financial statements. So when we compare the previous period information and this period information, we can tell like a story. Last year profit was like that. Now present year profit is this. So due to some reasons our profit has fallen down or increased. Such kind of narratives, some kind of description can be given. Now we look at additional comparative information. Comparative information in addition to the minimum comparative financial statement required by Sri Lanka Financial Reporting Standard, as long as that information is prepared in accordance with SLFRS. When this is the case, the entity shall present related note information for those additional statements. So they can give additional information other than the minimum comparative information. Consistency of presentation, consistency. So they have to follow a same policy previous period and this period. Then only we can compare. Consistency of presentation. When look at the structure of the financial statement, the common structure, but the appearance somewhat different. So they should maintain a consistency. So when you look at the another financial statement, so the same year, same company, right? So yeah. Here you can find a financial statement of another company. So this style is different. Style is different. Here, this style is different. And when you look at so the finance company, so their appearance is different. But they have to follow a consistency. Right? So this year they have followed this style, next year they follow another style, not like that. So they have to use, they have to follow a consistency. So an entity shall retain the presentation and classification of item in the financial statement from one period to next, unless sometime they can change their consistency of presentation. It's apparent, it's obvious, right? It's apparent following a significant changes in the nature of entity's operation or a review of its financial statements that another presentation or classification would be more appropriate when having regard to the criteria for the selection and application of accounting policies in LKAS 8. Sometimes the company may change their policy, or the company, the reviewers suggest, to change its consistency. So when they change, it will give more informations. It will give more clear information. So in that instances, they can violate the consistency of presentation. And a standard requires a change in presentation. Sometimes the new accounting standards comes. So earlier we had Sri Lanka Accounting Standard. In 2012, they have introduced a new accounting standard. Due to introduction of new accounting standard, it requires entities to change their consistency of presentation. In that instance also they can violate consistency of presentation. For example, a significant acquisition or disposal or a review of the presentation of the financial statements might suggest that the financial statements need to be presented differently. An entity changes the presentation of its financial statement only if the changed presentation provides information that's reliable. That information is reliable and more relevant to users of financial statement, and revised the structure is likely to continue so that comparability is not impaired. When making such changes in presentation, an entity reclassifies its comparative information as well. Now, that's all about today's presentation.